Hey folks, this is Big Mike Zlatnik. I'm recording this on Thursday, March 20th, and I'm going to provide some commentary on the Federal Reserve meeting that completed yesterday, March 19th, and the Fed decision. And the decision was steady as you go. The Fed kept interest rates unchanged. So let's talk about what does it mean? What are the impacts? Also, as always, every investor in the world, or maybe not every investor in the world, but a large number of investors listen to every word of the commentary that the Fed chair provides after the meeting. It's a little fascinating how many commentators looking for every word, and they want to pick on a given word. So we'll start by picking on a word transitory. The Fed chair Jay Powell said that the potential inflation driven by the Trumponomics, especially tariffs, he believes it's going to be transitory. So there are multiple articles after that alluding to the fact that the Fed missed inflation acceleration in the post-COVID world and called that inflation transitory. And now, again, they're using the word transitory. So there's a little bit of a danger in the use of the word. So why it's a little hilarious is because in the past, it was a reason to keep the rates low for too long. And now maybe he's keeping the rates high for too long. Who knows? Fed is always late. And this is the crazy part. They look in the rear view mirror, and they don't just look at the rear view mirror. They average the last 12 months. So they need to see inflation steadily coming down, not just the last couple of months, but the momentum of the last 12 months average. So we'll get there in a second, but let me just sort of cover a couple of important topics, what transpired. So it's a wait and see stance on how the Trumponomics, especially the trade policy, is going to impact inflation, unemployment, and the overall economy. Uncertainty has increased, in the words of Jay Powell. So FOMC noted an elevated level of ambiguity surrounding the current climate. They just call them technical terms. In the plain language, they just don't know, and they don't want to make the wrong decision again, and they're not comfortable to move ahead of the problems. Fed is in the emergency room medicine. They are not in the preventive medicine. I've said this many times, and some great folks have talked about this concept. So they don't have an emergency on their hands, one way or the other. So inflation is cooling a little bit, but maybe not, right? So they kept the Fed funds rate unchanged with a target between 4.25% to 4.5%. Overall expectation by the central bank is that the economy will weaken, slowing GDP growth down to 1.7 annual rate from a higher projection in December. And a previous projection was 2.1%, and now the forward projection is 1.7% for the 2025 year. So it's a reduction in the GDP growth by 0.4%. Now, on the inflation front, the Fed is expecting the core prices, core inflation, to grow at 2.8% annual pace, which is 0.3% higher than the previous estimate. So they're worried about the inflation driven by the tariffs in essence. Further, they're scaling back infamous quantitative tightening, or maybe famous, I don't know. It used to be quantitative easing, and now it's quantitative tightening, QT. What this means is they're going to slowly reducing the Fed balance sheet on leveraging. So they're looking to hold less U.S. Treasuries on the Fed balance sheet, but they're slowing down that reduction of the balance sheet, which is basically they're selling less Treasuries. That's what they're doing, effectively allowing the rates to come down naturally through the market forces. According to the dot plot, consensus is still for 2 rate cuts later this year, but more folks are turning a bit more hawkish, projecting 0 or 1 cut. So we shall see, but there is a little bit of adjustment to the Fed stance, simply driven the uncertainty of tariffs and what they may do for the overall inflation. As usually, the Fed left their options open, stating that if the labor market were to weaken unexpectedly, or inflation were to fall more quickly than anticipated, we can ease policy accordingly. So we will see, and they will see. It's a wait and see stance. Give it more time. How the current administration policies will impact unemployment, inflation, GDP, other elements, trade, and there's no news. No news is a good news in essence. But let me just do a couple of comments about what this means. As interest rates stay at the elevated level, it continues to be significant pressure for commercial real estate deals that we're looking forward to a potential rate cut. Although it was widely expected the Fed to do nothing, and they did that. But higher for longer policy continues to create challenges for commercial real estate as it continues to build pressure. Projects that have been under pressure, the pressure stays on. So as a result, it creates better buying opportunities. More distressed assets continue to come to the market as a result of higher for longer policy. So it's not great for existing investors with assets that need a relief in the interest rate policy, but it is certainly more attractive for the new acquisitions if folks can come in with a vulture mentality and get great deals. And it's a buyer's market in a matter of speaking. So higher for longer policy stance will continue to keep the market in the CRE in general somewhat depressed, slowing down the recovery until the interest rates actually start coming down. So for the time being, we are in the wait and see mode, and new opportunities for new capital deployments will continue to be really interesting this year in the next upcoming months and quarters. And then we'll see when the market will start stabilizing. Much, of course, depends on what the Fed does and the market expectations, and the bond market will adjust the pricing of the yield of medium and long maturity treasuries accordingly. The market has a mind of its own. The Fed does not control long end of the yield curve. It only controls the short end of the yield curve through the Fed funds rate. And its impact on the long end of the curve is through the quantitative tightening, the ability to buy and sell treasuries, or quantitative easing. So at the moment, they just expressed that they will slow down QT, meaning that they will put a little bit less pressure, allowing interest rates to flow down on the lower end of the yield curve. That's about it. However exciting it is, that's the news. Appreciate your time and attention. Until the next time, have a wonderful day.